Today on InvestTalk, we discuss why using the S&P 500 as your portfolio benchmark is likely a bad idea. Then we shine some light on the mixed market today. We also answer questions about ConocoPhillips, PPG, buying corporate bonds, and more. And at the end, we look at productivity gains created by the AI boom.
This is InvestTalk, independent thinking, shared success.
Our main focus point today concerns this warning. Don't compare your retirement investments to the S&P 500. And this is a great topic, Luke, because we get this all the time. It's okay, what did the S&P do? What did and then people tend to use that as a benchmark to their overall investment returns. Sometimes they're doing better than the S&P, sometimes they're doing worse. But the biggest issue is that most people are in many ways comparing apples to oranges here and giving them a really an unrealistic look of how well they're doing or not, right?
Yeah, I think that's accurate. I think that this goes back to one of my favorite topics, which you know very well, which is benchmarking, right? And understanding that your investment strategy doesn't necessarily line up to what people perceive as U.S. market performance as judged by the S&P 500. Let's say you're in your 70s. And the primary role for your investment account is what? It's
income.
It is liability matching. It is making up for this stream of costs that you have while you don't have much coming into it. So then is your proper benchmark what is now primarily large cap US tech? No, of course not. And so I think this is a great discussion to have on the back of two incredible years within the US market and understanding that the purpose of your investment account has as much influence on what your benchmark should be as your risk tolerance does.
Yeah. And the risk tolerance is, I think, the most important topic here because the reason we try to pinpoint our clients' risk tolerance level is because the biggest mistake that most people make is performance chasing. And that can mean on the upside or the downside. So you just talked about us having 2 great years in equities. And so if someone is taking lower risk than the overall market, they're unlikely to have kept up with the overall returns of the market. And they're in times like this, they tend to get FOMO, they tend to performance chase, and they tend to up their risk after the market's already higher, valuations are up, and the future returns of risky assets tend to be lower. And so they tend to take more risk at the wrong time. And vice versa. When you have down markets, like say 2022, and that's when the people who were taking risk felt it the most. Okay. And many of those in the back half of 2022 started to get queasy on the losses they were seeing, especially if they were allocated heavily towards tech and the NASDAQ. You know, NASDAQ was down 33% in 2022. And what did they do? They tended to lower their risk because they were feeling it right at the wrong time. And so that's the issue, is that usually your portfolio doesn't look just like the S&P 500, and you rightly should take lower or more risk than the market. And that's based on your goals, based on your risk tolerance level, how comfortable you are with seeing losses. That's the nature of investing. There are going to be losses at some point, and it's how you deal with those losses and the decisions you make when times are the toughest, either through FOMO or fear, that really will define the success of your portfolio overall. Does that make sense?
It does. And I want to say something controversial here.
Yeah.
Nobody's goal for their retirement account is making as much money as possible.
Yeah.
That's not the goal for your retirement account. The goal for your retirement account is to fund the lifestyle that you want in retirement. That is inherently about matching the spending you're going to have. And matching the spending you're going to have, some of which is something you can't get rid of, right? You have to pay for housing, you have to pay for rent, you have to pay for food, you have to pay for whatever, what have you, is spending that you can't risk not being able to pay.
Yeah.
And therefore, making the riskiest investments to make the most money is not your goal and should not be your strategy.
Yeah, it should be to cover your future cash flow obligations. That's what you're doing here, right? You're trying to amass a nest egg so that you can have financial freedom and you can live your life how you want it to be lived, and you can use those assets to cover your cash flow needs for the rest of your life. That's what retirement planning is. This is something that we do for our clients. We project out, with withdrawals in retirement. That's what's important here, is that people look at, if I have this number, if I get $2 million, I'm going to have enough money. No, that's not how you should be thinking about this. You should be thinking about, what are my withdrawal needs based on my expenses, which sometimes can be lumpy, based on my taxes, okay, and how long I'm comfortable working. And then, what is my Social Security income? What is my rental income? What is my deferred compensation potentially? All of these go into a full financial plan. And then you say, okay, then what are my withdrawal needs beyond these other guaranteed income? And then how can I most effectively and efficiently take my current assets and invest it properly to meet those goals? And that's ultimately what your end goal should be for your investments. It's not, like you said, to make the most money, because if that's what you're trying to do, is just maximize the potential for making the most money, what you also do is maximize the potential for losing the most money, right? Because there's a risk reward calculation here that you need to get right. And guess what? The S&P 500 is often not the best risk versus reward calculation for your particular situation. And until you understand that, then your benchmarking to the S&P is going to be far off.
Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates. Now let's quickly look at the market today. Luke, it was a decidedly positive day overall to start the day, but we faded kind of throughout. What did you see in the markets today?
Yeah, well, I think one of the big drivers of the positive move in the market today could be relative to some more discussion around tariffs. There's some speculation of based off of a report that Trump may be scaling back universal tariffs, focusing instead on critical imports like steel, pharmaceuticals, and rare earth metals. Now, even if that were the case, that could still impact GDP, with estimates of about 80 basis points to 1.4% point reduction. For what it's worth, the president-elect did deny those reports, so take that with a grain of salt. But that was certainly a positive driver today.
It cut out. I think Luke cut out. All right, I will continue. So, so it was. Luke, you still there?
I'm still here. Can you hear me?
You cut out. So can you
Where
start
did
over
I
with
cut
that?
out?
There
Sure. So I think one of the positive drivers today, and hopefully I don't cut out again this time, just after telling you all we have no mistakes in this show, but we are all human.
Yes.
But I think one of the big positive drivers is probably the report that there would be pared back tariffs focusing on critical minerals like steel, pharmaceuticals, and rare earth metals instead of a universal tariff. Now, that would still decrease GDP. And again, for what it's worth, the president-elect did deny those reports. But that is something that did bolster the market today.
Yeah, and we saw, what were the big movers on the day? I'm looking at the heat map. NVIDIA was up about 3.4%. Amazon up about 1.5%. T-Mobile was down 3%. That was probably one of the biggest down movers in the S&P today. But overall, yeah, kind of a mixed bag. And we're what, 2 weeks away from Inauguration Day. And I think then you'll get a little more concrete news on the movements of the new administration and how that will really impact markets. I do think we are in a period where you could experience more volatility, especially as you get closer to OPEX in a couple of weeks. And I expect choppiness. That's what I'm expecting for markets in the near term.
Hey guys, Kyle from Texas here. Just calling about American Electric Power, ticker AEP. Earnings look good. Forecast earnings look all right. Pays a dividend. Balance sheet looks pretty decent. Down about 10% in it. See what you guys think about it. Thank you guys. Love the show.
All right. Looking at American Electric Power. And this is actually a name we've owned for clients for some time. It has pulled back since its peak in September, around $105. Now we're at $90. But that's happened to the whole utility sector. you've had a nice pullback there. And but this is a out of Ohio, and they have a lot of exposure to the Midwest, Arkansas, Indiana, Kentucky, Louisiana, Michigan, Ohio, Oklahoma, Tennessee, Texas, West Virginia, and Virginia. That's where it operates, and it is an electric utility. What are you seeing, Luke, on the profitability evaluation front?
Yeah, well, on the valuation front, it's pretty reasonable at this moment. It's trading at 15.6 times forward-looking earnings, only about 1.8 times its book value. Its 5-year average, for context, being right around 2 times its book value. And so you mentioned it a little bit. Last year, we had a pretty solid run-up in utility companies. And as interest rates are coming down, investors are seeking different areas to get dividend yield, right? Higher income investments. People did tend to turn to utilities, but there's also that other secular driver that is really boosting these names, and that is the growth of data centers and the demand for power because of that. And so when looking at utilities, you kind of have to keep that in mind as to being probably a primary driver in the coming years of revenue growth.
Yeah, that's definitely true, and that's what's been happening with American Electric Power. Not growing a ton, but better than most utilities that are out there. And it's come down mainly because utilities in general have come down, and the bond. Remember, utilities are a bond proxy, and the rates on the 10-year have started to come up since the beginning, call it mid-September, and to that end, that's why you're seeing some weakness in American Electric Power. But, we own it for clients. Now, for caveat, we don't own a lot of utilities. They tend to not be great long-term drivers of returns. They just over the extended periods are one of the worst sectors in total return. But they tend to be lower volatility, and they're good portfolio diversifiers. So we own it more as a portfolio diversifier. This is kind of one of the best in this industry. So we like it, but understand that you don't want to have huge exposure to utilities unless you're really focused on income as a driver. Because look, once again, long term, they're just not. It's not a great sector to buy and hold for an extended periods. Okay. Thanks for the call. We're going to go to Robert in Pleasanton, looking at OLP. How you doing, Robert?
Great. Happy New Year to both of you. It's a treat to have a 2-for-1 here.
Appreciate it.
What do you guys think about OLP?
So OLP, it's a REIT, and it acquires retail, industrial, office, and healthcare properties in 31 states. So it's fairly well diversified. So I do like that. Now, REITs have been weak as of late. So the question is, how much do you want to step into REITs at the current time with this overall weakness? And OLP was down again today. What are you seeing, Luke, on OLP?
Yeah, well, from a net income perspective, it has some pretty solid growth, about 7.8% on an annualized basis over the past 3 years. It's not too expensive. Its price per funds from operations is only about 14, though it is above its 5-year average of about 12. It's important to note also it is a triple net lease, triple net REIT, which has some tax benefits there to the REIT itself. But I think overall it's one of those things where, to me, you mentioned it before, it's what's really driving REIT prices downward and something that's really affecting the sector overall. So the question isn't, in my opinion, is OLP the right REIT to get into, but is it the right time to continue to allocate to the REIT space generally?
Yeah, I'm seeing some weakness here for the near term. Let me find a support level for you on OLP, because I don't dislike the actual name. I like that it's fairly well diversified. It's not just tied to one particular subsector of the REIT space. Next support level will be around 25, but I wouldn't really be aggressive until about 24. Okay, 24 is the level that I would be interested in OLP. Remember, this is a very small cap REIT, $565 million market cap. So even though it operates over 31 states, not a ton of assets. And so I think you're going to experience some volatility. I wouldn't be buying it for that 6.8% yield, though, because that is likely to be volatile because its payout ratio is pretty high. But I would be trying to pick it up from a valuation perspective around 24. And another hint that they may not be raising that dividend anytime soon is they haven't raised it since 2018. So obviously, they're trying to repair the balance sheet because they do have a good amount of debt. And so I would be very patient on OLP down to 24. Thanks for the call. Now, I hope everyone knows that you can find us over on our YouTube channel in video form. You can see my charts and the data that we share every day over there. So I encourage you to head over there, like and subscribe to that channel, and check out us in video form. But we get questions in the comments section all the time. So let's tackle one of those now. And it says, Kevin Perryman says, how do you guys feel about China's industrial overcapacity and the effects it will have on the global supply chain? Well, my first reaction to that, Luke, is simply that's deflationary for the Chinese economy, but also to the rest of the world. We know that China tends to dump their products on the rest of the world, which is deflationary. And that's my first reaction to that. What's your reaction to that question?
Well, my first reaction is something that I mentioned at the top of the show, which is tariffs, right? This current administration has used tariffs sparingly, but still to protect what they believe to be critical industries. The next administration certainly isn't afraid of tariffs. And so is overcapacity an issue for domestic manufacturing? Yes, but only if you allow those products into the market, into the US, into Europe, both places where maybe they're taking a more adversarial role with China moving forward. It's
a good point. Yeah. If the overcapacity is not resolved through exports, then it doesn't have much impact on the rest of the world. So yeah, I think you're right that those tariffs will be very important to see how that manifests in the rest of the world. Let's go talk to a live caller, Richard in Santa Clarita, looking at Lockheed Martin. Do you own it or looking to buy it?
I have a small position in it.
Okay.
The reason I looking at this one over the last 6 months, it really shot up, about 3 months ago, and now it's kind of coming back down to almost where it was 6 months ago. There are a lot of factors, environmentally, a new administration who emphasizes a strong defense, but also wants to, make cutbacks and make things more efficient. We've got the Ukraine war that's been going on. Let's see what happens there in terms of with the new administration if they negotiate, some situation. But this one, is this a good place to buy in at this point, would you say?
A lot of potential issues with the new administration and the military industrial complex, and Lockheed would be part of that. Is that correct?
Yeah, it seems like there's certain. I think it probably depends. We don't know how it's going to go.
Of course not,
in terms of administration wise.
Yeah.
On the one hand, they emphasize a strong defense. On the other hand, they're looking at cutting inefficiencies.
Yeah, exactly. And I think it's pretty clear. You're talking about the Doge, whether it's going to be successful or not. I think the to be in the military industrial complex, right? And trying to reduce defense spending and more like defense waste, which ultimately will reduce defense spending and hit company like Lockheed Martin. I think that's one of the reasons why this has fallen so dramatically from $620 just a couple of months ago, now down to $466 to close today. And I'd agree. If you look at the losing my train of thought here. Luke, help me out.
I can't enter your brain, so I don't know where your train of thought is going. But I certainly do think that you have dueling narratives here, right? There has been, let's say, in my lifetime, no administration that has gone in since Bill Clinton and actually cut the deficit.
Yeah.
Right. They all enter talking about cutting spending, but nobody ever really wants to touch the military budget. They never do. Is this one going to be different? maybe, but oftentimes the future is exactly what we've seen in the past.
Yep.
Now, the administration has said, or the future administration has said, they do want to take a step back from what has been our unilateral defense role in the world. So what does that mean for other countries? Well, that means that other countries that have relied on U.S. military strength may have to rearm themselves in a way that we haven't seen in decades. That also could be good for the military industrial complex. And so when I look at a name like Lockheed Martin, I'm a little bit more concerned about, what the government is going to do with respect to its F-35 program, which has been not so great in terms of actually delivering, right? Been a massive waste. There was a bad announcement coming out of that recently, and there were some valuation concerns, right? They're trading at 17.2 times forward-looking earnings, and that's after the rundown. And so what I see this more as is not really a thematic change in terms of how the U.S. or international powers are going to be spending in terms of defense spending, and more of a coming back down to reality from what we saw a couple months ago, where it was trading at 19, 20 times forward-looking earnings, which was crazy valuation. So that's kind of how I look at Lockheed Martin.
Yeah, you make a good point with potentially Europe and the rest of the world having to step up their spending themselves, and maybe us reducing our spending. But I think it becomes more up in the air, right? For the Lockheed Martins of the world and the other large defense contractors that are out there, they have a strong grip on the U.S. On Congress and spending, right? Whereas do they have as much influence on the rest of the world? Probably not. So it's certainly more up in the air. Even if those other countries are going to spend more, who it's up in there who will benefit. So I think I would not step in front of this. The technicals are terrible. You are hitting some support here right around the 460 level. We're at 466 now, but it's not slowing down, and it looks like it potentially wants to break through those levels in a big way. So I would not be quick to jump in front of this. I'd want to see some reversal, some strength that can tell me that the market is starting to have a bit more confidence that this administration isn't going to crack down on a lot of inefficiencies. So a name to watch, have on the watch list, but I absolutely would not be stepping in front of it at the current time.
Great. All right. Well, thank you very much.
No problem. Thanks for the call. For more insights and resources, visit us at InvestTalk.com. Let's go take another live call. Gene in North Carolina asking about buying corporate bonds. Happy New Year, Gene.
Happy New Year to you, Justin, and to Luke as well. Yes, I'm interested in buying investment-grade individual corporate bonds that are newly issued. And I was led to believe by looking at certain ratings of discount brokerages that the offerings for such bonds varied quite a bit from one discount broker to another. My only experience has been with Schwab and Fidelity, and I do see that Schwab definitely has more to offer on any given day than Fidelity. But I was led to believe by this rating of discount brokerages that E-Trade was actually the better one that had the best offerings. Do you and Luke have any feelings for this?
Well, first off, when you're going to buy corporate bonds, you talk about new issues. You're probably not getting new issues. New issues are typically placed with institutions that have large amounts of money. What you're typically buying are bonds after they've been issued. Okay, they're above or below par. How these brokerages make money is they charge a spread, and that can vary depending on the broker, depending on the position. And especially when you're buying small dollar amounts like the average person is, those spreads can be fairly wide. Now, we've never used E-Trade, but obviously we use Schwab. And, I've traded them at Fidelity throughout the years before, but I don't have a strong opinion on Fidelity. But I know Schwab is pretty good, but I haven't used E-Trade myself. Luke, do you have any experience with any one of these?
No, I haven't used E-Trade either, though. I do want to emphasize what you're saying, and that the size of the trade does matter for the spread that you're paying. And I'm not exactly sure what the difference is going to be between using one of those traditional custodians like Schwab, who also works as a broker, versus working with E-Trade, who primarily got its start as just being a brokerage. So not much to add there.
Yeah, and you are at a pretty large disadvantage by working on your own. We're buying, when we go buy bonds for clients, we're buying, hundreds of thousands, sometimes millions of dollars worth of bonds. And that helps with get pretty good spreads and better overall yield for those bonds. So understand that. But yeah, I can't really tell you which one is going to be better because I haven't experienced E-Trade.
You able to hear my voice?
Say it again.
I'm sorry. Are you able to hear my voice? It didn't sound like it. I understand that the spread is a deal is a concern, but the ones I'm interested in are newly issued. It's before the first settlement date.
Okay.
I'm actually thinking what I was led to believe actually was that E-Trade actually had more offerings on any given day, not even talking about the spread. And I'm wondering, I know that maybe you and Luke don't have any direct dealings with E-Trade, but you do transfer accounts from other people to Schwab. And I'm wondering, have you seen people transferring with E-Trade that have more bonds, for example, or more corporate bonds?
Oh, I mean, we certainly have transferred in accounts from E-Trade, and many of those certainly have bonds. But it doesn't tell us much about, the where they got those bonds. They may have transferred those bonds from somewhere else. They may, they may have bought not newly issued bonds, right, off the run bonds. So it doesn't really. We don't really have anything to give you that says E-Trade is a good place to go or not.
Okay, well, thanks a lot then.
No problem. Sorry we couldn't help, Jane, but good luck. Now, here comes another live call. James from New York asking about COP and listening on the podcast.
Yes, good evening. So I was thinking about adding some more exposure to the energy sector, and I'm just wondering if COP is a good value here, just under $100, or shall I wait to see if it falls more?
Yeah, ConocoPhillips is the name we've owned for a while, and in our covered call strategy, and pays about a 3% dividend yield. And the reason, one of the reasons we like ConocoPhillips is they have actually a high level of natural gas exposure compared to the rest of the majors, and so that's why it's held up better than a lot of the other the majors that are out there, even though it's down because that's just oil prices are down. But this is definitely a name that we like compared to the other big oil companies. What are you seeing on your end, Luke?
Yeah, well, that's certainly something I agree with. And people have called in pretty frequently about energy names, right? Especially because of how poorly they did in the past 3 months to end the year, what's been happening with oil prices. And something that I have said consistently is for us, right, because we are making investments for our clients as well within the energy sector, what we're looking at is natural gas, and we're looking at efficiency in getting products to market. And so for ConocoPhillips, that's about 30% of their business is natural gas. And so that's something that I do certainly like. It's important to note, though, I think B of A today anticipated the price of oil, which does make up the majority of their business, about 51% of their business is crude oil. They expect the price of oil to be around $65 a barrel in 2025, probably primarily driven by increases in supply from non-OPEC countries. And so that's something to consider as well when you're looking at a blended company that not only is investing in natural gas, but also investing in crude oil.
Yeah, exactly. I do think that we're fairly range bound in crude, but the demand for natural gas is rising dramatically because of the AI drive towards producing consistent energy. And until we get nuclear really moving in this country and around the world, natural gas is kind of that swing fuel that's going to be used for those purposes. So we're pretty bullish on natural gas. So if you're looking for a major oil company, this is a pretty good one. If you're looking for more of a pure play or natural gas name, then obviously there will be others that are out there. Now, we love your live calls, so let's keep going. This time, it's Bill from Northern California asking about PPG and listening on InvestTalk on AM 1220 in the Bay Area.
Good afternoon to both of you gentlemen, and nice to hear you together.
Appreciate it.
Like a double whammy.
There you go.
Maybe I want to hear if there's any difference in your opinions.
Yeah, there are always a little bit, for sure.
So yeah, I bought some of this PPG going back in this. I like to buy stocks on a discount. So, I was looking at it and reading up what I could back last summer, and I was buying some in the 120s. I think the lowest price I have it's like 119 or something. But, it's down right now, and I just wondered why you see that it would be particularly down at this time, and how you see the strength of the company and their ability to maintain the dividend and, their long-term prospects in the next year or two.
All right, looking at PPG Industries, and this is a company that mainly makes coatings, glass, and chemicals for packaging, aerospace, architecture, etc. I think one of the main reasons why the stock is down is earnings expectations continue to be downgraded for full year 2024 and this year. And so obviously the multiples are coming down, but it's down to kind of the mid-teens multiple going forward, which is pretty cheap. They have a pretty good balance sheet, good cash flow. What are you seeing? Like, I think this looks fairly cheap on my end. What about you?
Yeah, it does look cheap, but for some, sometimes things are cheap for a reason. I think it's not just disappointing earnings. I think it's that they initiated a cost-cutting program, right? They fired 1,800 employees. And typically when companies go in and they say, well, we're going to have a dedicated cost-cutting program, that's kind of a signal that they can't really deal with the other side of what drives profitability, which is revenue growth. And so that's kind of a worrying sign that I'm seeing. They also sold off part of their business, their architectural coatings business, to a different company for about $500 million. And so honestly, it seems to me that it's a company that is struggling to find the growth that it had earlier in the past 5 years and has struggled to have over the past couple years, and trying to find a new way to move forward.
Yeah, and that does worry me a bit too. I like the business, but I just don't like the technicals. And it looks like this wants to break below its support from a couple of years ago. I probably wouldn't look at this until about $99. That's probably where I'd pick up PPG.
Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
Hi, Justin or Luke. Happy New Year. I'm calling today about ticker symbol BWXT, BWX Technologies. I'm looking to add to my nuclear area of my investing portfolio. I already have CCJ, but this seems like a picks and shovels and it might work well with the rest of my portfolio. Wondering, I've had this on my watch list for quite some time, wondering if you can take a look for me at the financials. I don't know, it might be a little bit expensive, be kind of high, but looks like there's some good support at the 105 level. Maybe I can buy a little bit now and then add to my position if it gets down there. Please take a look and let me know. Thank you. Have a good day. Bye.
All right, looking at BWX Technologies, a name that we've owned for a while for clients. It's at $114 per share. I think we bought it in the 60s or 70s. I can't remember exactly, but it was over a year ago. And what they do is they're a specialty manufacturer and service provider of nuclear components. Two segments. Government operations segment consists of a legacy nuclear operations group. So this is good because a lot of the old nuclear facilities are actually being restarted, like 3 Mile Island. And then you have advanced reactors, advanced manufacturing, so the development of newer reactors as well. So they have their hand in there. So just a lot of good tailwinds for this company and the sector as a whole. So that's one reason we bought it. Now, our revenue growth was 14% last quarter, 24% on the earnings side. So they're growing pretty nicely. The trends are positive. It's pulled back from 135 to the 114 now, but generally is in a good uptrend. 81 is the relative strength rating. And what are you seeing, Luke, on the balance sheet side and profitability?
Yeah, I mean, not a lot of debt. Not a lot of debt, only about $1.2 billion in debt on a $10.3 billion market cap company. They've been buying back shares. They pay a modest yet consistent dividend. Around 80 basis points is where it stands now. It's usually modulated between about 1% and 2% over the past 5 years. Their margins have been expanding over the past couple of years. Their cash flow looks better. And so the chart is really reflecting the performance of the company and the overall theme that has driven this industry broadly. Now, one thing that I am concerned with about a company like this is that 81% of its revenue is from government contracts, right? And so new administration, new priorities, someone who has the ear of the president-elect who is heavily invested in solar panels could change, how we decide to spend this money on these government contracts, which are already awarded and won. So probably we won't see anything happen there. But, 5-10 years from now, what does a re-upping of contract look like? Either way, for a nuclear play, I think this is a great company. Obviously, we own it for clients. So not really much to add beyond that.
There we go. That's BWXT. Now, Luke, let's talk a little bit about productivity. And productivity in the U.S. is pretty strong as of late. Okay, if you look at the total output of the economy divided by the hours worked, that's productivity. It rose 2% in the third quarter compared to a year earlier. That's the fifth quarter in a row with an increase of over 2%. Now, in the 5 years before the pandemic, there were only 2 such quarters. And back then, there was a lot of worry that the U.S. worker was struggling on the productivity side. And what happens with productivity is if you get more out of workers, that tends to be deflationary for the economy, kind of reins in inflationary impulses. And so this, along with some other factors, have helped the inflation picture come back into the 2 to 3% level. And overall is good for profitability and productivity of the economy. And so there are a few reasons for this. One is technology. New technologies are helping the current workforce become more efficient. And then immigration. More immigrants are coming into more manually intensive jobs, which allows for current workers to move up and do highly skilled jobs as well. What do you think the reason for this surge in productivity?
Yeah, well, I think you mentioned it. The primary driver is just technology, right? The technological curve is exponential. Technology builds upon technology. And maybe that even can counteract some of the other issues within the labor force over the next 10 years, which is an aging labor force, potential less participation down the road. So is this sustainable? I don't know. It really depends on the technology.
Yeah, how AI continues to evolve. I think that's a big factor here. More video conferencing, less time-consuming trips, QR codes instead of menus, things like that, I think are a big reason why this is all happening. And it's a good trend for the economy. With all the pessimism out there, this is definitely a ray of light for the broader economy. I'm Justin Klein with Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and calculate your investor risk number if you head over to investtalk.com and click on the portfolio review button and schedule a time with me or Luke. And this is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.